All right, so looking at Alphabet, the holding company of Google, also YouTube, and other smaller divisions. So talking about Google Fiber, Verily Health, Isomorphic Labs, Waymo, autonomous driving, and a whole bunch of other forward-looking companies under that same umbrella. So Google, 99% of the revenue there, 80% of that is coming from online advertising. So heavily focused in that business. Um, Also getting revenue from app sales, content that it creates, cloud service fees, licensing fees, hardware. So Chromebook, Pixel smartphones, all contributing there. Healthy operating margin for this business. So 25 to 30% operating margin there. So in a good spot for that. Management. So current CEO is Sundar, who has had a strong track record in his tenure of revenue and also share price growth during his time there. So the founders, Larry Page, Sergey Brin, has stepped back, focused more on forward-looking projects there, um, which is good. It's probably optimized the company's financial health and just overall valuation there. Also got divorced board membership from companies across the United States there. Some drawbacks with board, some regulatory concern that they have not managed to stay out of. So fines in the European Union, also antitrust regulation fines coming up in Asia and India continues to be an issue for Alphabet. Makes the news a lot for the company, so that continues to be a hit going forward. Also, room for improvement and optimizing the growth drivers for the company and making sure that share price can reflect the true value of the company too. So investors would love to see more of that. So for the company's moat, large market share for web and iOS based search and email, and it's the largest in the world. Also got a healthy cloud services division, which will be huge going forward. So 90% of all web searches still going through Google. It's still massive market share control there, dominates it. Also major cash war chest, so $160 billion. Definitely consider that a moat. So mispricing, definitely cheaper valuation metrics compared to its peers. Lower PE and PEG ratio when you're looking at Microsoft, Apple, and Facebook. Also, its lowest PEG ratio for the company in the last decade. So recent pullback similarly added to that to it. Definitely attractive valuation. Fair value for Morningstar 3,400. DCF puts it at 3,100. Definitely has mark and charity in the Bay Area and worldwide. So you also have that as a plus for the company when you're looking at their value standpoint. But overall, rated as a buy, somewhere in the $3,200 range. Healthy blue chip, healthy growth stock, kind of a hybrid there. So very steady, but also promising 20% revenue growth. Makes it very strong looking forward. So